Welcome back. Today we're tackling a big one, the US dollar. We're going to look at its story, and specifically how what it can buy has totally changed over the last century.
So, to really get our heads around this, let's travel back in time. Picture it. It's 1913, the year the Federal Reserve was born. What could one single dollar actually get you back then?
Well, it turns out, a lot. Check this out. $1 could get you 30, that's 30, Hershey's chocolate bars. Can you even imagine that today?
Okay, now let's fast forward. Back to the present. We're asking the same exact question. What does that $1 bill get you now?
Yeah, not quite as much, huh? That same dollar might get you maybe a single pack of gummy worms. So this is the big question, right? How did we go from a mountain of chocolate to one little bag of gummies?
This chart pretty much tells the whole story. It's just this staggering, long-term drop in what's called purchasing power. We're talking about the US dollar losing over 97% of its value since 1913. That's insane. So let's dig in and figure out how and why this happened.
All right, here's how we're going to break this down. First, we'll look at your shrinking dollar, then the inflation engine behind it all. After that, we'll hit three major historical shocks that sped things up. And finally, we'll see how the rest of the world is reacting.
Okay, part one, your shrinking dollar. And really, we've already seen it, right? The 30 chocolates versus the one pack of gummies. That right there is the shrinking dollar in a nutshell. It's this idea that your money just doesn't go as far as it used to.
But why? Why does it shrink? To get that, we've got to pop the hood on the economy and look at the engine driving this whole thing. And that engine is inflation.
So first, let's make sure we're on the same page with this term, purchasing power. All it means is how much stuff can your money actually buy? It's the perfect way to describe the chocolate bar situation.
And here's the key relationship you need to get. Think of purchasing power and inflation like they're on a seesaw. When inflation goes up, your purchasing power goes down. They're always moving in opposite directions. When things cost more, your dollar buys less. Simple as that.
So what drives inflation? Well, a huge factor is just how much money is out there. Economists have this fancy term for it, M2 money supply, but really, it's just a way of counting up all the cash floating around, everything from the bills in your pocket to what's in your savings account.
And this quote really nails the problem. See, having more money in the economy isn't necessarily a bad thing. It gets tricky when the amount of money grows faster than the amount of actual stuff we're making. Cars, food, services. When you have more and more dollars chasing the same amount of goods, prices tend to go up.
Now, this whole thing wasn't just some slow, gentle slide. There were specific moments in history that acted like rocket boosters for this decline, just kicking it into overdrive. Let's look at three of them.
You can really see three huge shocks in the data. First, you've got the World Wars, with all the spending that went along with them. Then, a massive one in 1971, ending the gold standard. And of course, much more recently, the huge government response to the pandemic.
Let's zoom in on that 1971 shock. See, before then, the US dollar was actually backed by physical gold. But when President Nixon took the US off the gold standard, it basically untethered the dollar. It gave the government way more freedom to create money, and look at the result. In just 10 years, the dollar's purchasing power got sliced by more than half.
And many of us remember this next one vividly. After the massive government spending during the COVID-19 pandemic, we saw another really sharp drop. It triggered the biggest spike in inflation we'd seen since the 80s, and you guessed it, took another big bite out of the dollar's value.
So, okay, this isn't just some dusty old history lesson. This trend has massive, real-world consequences today. And you better believe other countries around the globe are watching and reacting.
So what are they doing? Well, a lot of central banks, especially in places like China and Poland, are looking at all this and deciding to diversify. They don't want all their eggs in the US dollar basket, so they've been buying up gold like crazy, seeing it as a safer, more neutral place to store their wealth.
But it's not a one-way street. On the flip side, you've got a smaller group of countries doing the exact opposite. Places like the Philippines and Kazakhstan have actually been selling off some of their gold, a lot of times because they need the cash to deal with issues at home. It just goes to show you, not everyone has the same strategy here.
And all of this brings us to one final big question. I mean, when you look at this incredible 100-year decline, you have to wonder, if this trend keeps going, what's a dollar going to be worth in another 100 years? What will it buy for our grandkids? It really makes you think about the future of money itself.